You're standing on the sidelines watching gold prices skyrocket, telling yourself it's too late to buy. But behind the closed doors of the world's central banks, the largest gold rush in history is quietly unfolding. Why are the smartest financial minds on the planet scrambling to hoard the very asset they tell you is a dead rock? Today, we pull back the curtain on a massive global contradiction. This is the battle between smart money and the retail trap. And right now, someone is losing. To understand why you might be wrong, let's look at what the smart money is actually doing, rather than what they are saying. For decades, the financial world operated on a simple premise. The US dollar was king, and US treasuries were the ultimate safe haven. But look at the data from the World Gold Council, and you'll see a massive shift in the tectonic plates of global finance. We are witnessing a buying spree that hasn't been seen since the late 1960s. We are not talking about a few tons here and there. We are talking about hundreds of tons of physical bullion being moved into the vaults of nations like China, Russia, and India. In 2024 and 2025 alone, central bank gold demand reached record-breaking levels. But why? Why would a modern superpower, with all the digital tools and military might at its disposal, return to a barbaric relic like gold? The answer lies in a single, powerful concept: de-dollarization. For these nations, gold isn't just an investment, it's a declaration of independence. When the West froze Russia's foreign exchange reserves in 2022, every central bank in the world had a light bulb moment. They realized that if your wealth is stored in someone else's currency, your sovereignty is essentially on loan. By swapping dollars for gold, countries like those in the BRICS Plus bloc are building a financial fortress that no foreign power can switch off with the click of a button. But it's not just about geopolitics, it's about survival. The smart money is looking at the ballooning nợ global public debt, and they are terrified. As the US debt pushes past $34, $35, and soon $40 trillion, the world's biggest players are asking, can the math even work anymore? They know that eventually the only way to deal with that much debt is to devalue the currency. If you have a mountain of debt, you make the money worth less, so the debt becomes easier to pay off. That is the hidden tax of inflation. The giants, the people who actually run the global economy, are hedging against the inevitable decline of fiat currency. They are buying insurance against a system they helped build. Look at the scale of this. While the average person is being told that inflation is cooling and the economy is resilient, the People's Bank of China has been on a 17-month consecutive buying streak. Think about that. They aren't trading the daily noise of the stock market. They are making a decades-long bet. This is the ultimate defensive play. It's a move from promises to pay back to assets that don't require a counterparty. When you hold a dollar, you hold a promise from the US government. When you hold gold, you hold an asset that is nobody else's liability. It has no debt attached to it. It cannot be printed into oblivion by a central bank. The logic is cold, hard, and undeniable. The giants are moving into hard assets because they know the paper world is becoming increasingly fragile. They are preparing for a world where the dollar is no longer the sole arbiter of value. So if the people with the most information and the most power are exiting the dollar and entering the gold vault, what does that tell you about the optimistic news headlines you see every morning? It tells you that there is a massive disconnect between the narrative fed to the public and the reality unfolding in the global vaults. But here is the real kicker. Even as they buy, the trap for you, the retail investor, is being set. But why does the news always seem to break in a way that makes you want to sell exactly when the giants are starting to buy? This isn't a coincidence, it is a design. Welcome to the retail trap. To understand how the smart money exits or enters a position without moving the price against themselves, you have to understand one thing: liquidity. If a central bank or a massive hedge fund wants to buy billions in gold, they need someone to sell it to them. And who is the best person to buy from? A panicked retail investor who has been told that gold is a bubble or the economy is recovering. Think about the psychological warfare played out in the headlines you see every day. When gold is at its cyclical lows, the media is silent, or worse, they call it a dead asset. They wait until you're numb to the opportunity. Then, as the price starts to climb, they pivot. Suddenly, the narrative shifts to risk-off sentiment. They pump fear about an imminent collapse or a geopolitical explosion. Wait, isn't that a good thing? Doesn't fear drive people to gold? Yes, but here is the twist. They wait until the price has already moved. They lure you in at the local peak of a news cycle. This is what we call chasing the green candle. While you are rushing in, blinded by the fear of missing out, FOMO, the smart money, those who bought months ago in silence, is now using your buy orders to exit some of their positions at a profit. They use your excitement to fund their exit and your panic to fund their entry.
Let's look at the risk-off trap. When a geopolitical crisis hits, the headlines scream chaos. You see the price of gold spike and you panic buy. But often, within 48 hours, the price mysteriously drops back down. Why? Because the professional traders used that sudden spike in retail demand, that liquidity, to sell into the strength. They know that your emotions are their greatest profit margin. The media creates a numbness to the real risks. They focus on the temporary drama, the latest tweet or the monthly jobs report, to keep you from looking at the structural rot we discussed in Part 1. They want you focused on the noise so you don't see the signal. Ask yourself, when was the last time a major financial news network told you to buy gold and hold it for 10 years as insurance against currency debasement? Almost never. Instead, they treat gold like a speculative tech stock. They talk about technical setups and short-term resistance to keep you trading. Why? Because a trader who holds physical gold is a customer the financial system has lost. The system doesn't want you to be your own central bank. It wants you in the paper trap. It wants you in assets that they can track, tax, and dilute. Every time a retail investor sells their physical gold because a news anchor said the dollar is strong today, a Ga Hong Lo, a giant, is on the other side of that trade, smiling. They aren't just taking your gold, they are taking your insurance policy. They are taking your seat on the lifeboat. And the most brilliant part? They've convinced you that you're the one being rational. But we're only scratching the surface, because while the media keeps the West distracted with interest rate predictions, a new power structure is being built in the East that could render the entire paper trap irrelevant. If you think the US dollar still holds the steering wheel of the global economy, you're missing the biggest shift in 50 years. While the West is distracted by the daily noise of interest rate hikes and retail traps, a new power structure is being built in the East, one that could render the paper trap completely irrelevant. Enter the BRICS Plus nations. This isn't just a casual club of emerging economies anymore. With the inclusion of major energy titans like Saudi Arabia, the UAE, and Iran, this bloc now controls the majority of the world's oil and a massive chunk of global GDP. But their most dangerous weapon isn't oil. It's their plan to detach from the debt-based financial system. For half a century, the world operated on the petrodollar system. Oil was sold in dollars, and those dollars were recycled back into US treasuries. It was a perfect loop of debt and demand. But that loop is snapping. The BRICS Plus nations are actively developing a new unit of account, and all signs point to one foundation: hard assets.
They are moving toward a system where trade is settled not in promises to pay from a central bank, but in something with intrinsic value. This is why we are seeing the massive gold accumulation we discussed in Part 1. They aren't just buying gold, they are building a new gold standard from the ground up. Now, here is the fundamental shift you need to grasp. Gold isn't actually rising in price. That sounds crazy, right? You look at the chart and the line goes up. But think about it differently. Gold is a constant. An ounce of gold buys roughly the same amount of bread or fuel today as it did 100 years ago. What you are actually seeing is the collapse in the purchasing power of paper money. When you say gold is at an all-time high, what you are really saying is the dollar is at an all-time low relative to real wealth. The BRICS Plus nations understand this perfectly. They see that the US has weaponized the dollar and printed it into a state of structural decay. They are choosing to exit the burning building of fiat currency and move into the fortress of hard assets. By centering their future trade around gold and silver, these nations are moving toward a debt-free asset standard. In the Western system, money is created out of debt. Every dollar in your pocket is someone else's liability. In the Eastern system, money is being redefined as an asset that exists without a counterparty. It's a return to the hard asset lab of history, where wealth was measured by what you held, not what you were owed. Why does this matter to you? Because we are moving toward a bipolar financial world. On one side, you have the Western paper world, fueled by infinite debt and media-driven retail traps. On the other, you have the hard world, fueled by commodities, energy, and physical bullion. The smart money has already chosen their side.
They are ditching the IOUs and stacking the bars. They know that when the music stops, the person holding the physical asset is the only one who still has a seat. But there's one final piece to this puzzle. If the global system is shifting toward hard assets, why is the average person still so risk-numb to the situation? Why aren't more people panicking? The answer lies in a mathematical illusion called real yields, and it's the final wall keeping you from seeing the exit. The real yield lie is the final wall keeping you from seeing the exit. For years, conventional wisdom said when interest rates are high, gold suffers. Why? Because gold pays no dividend. If you can get 5% from a government bond, why hold a yellow metal that just sits there? But that logic is breaking. Look at the current market. Interest rates are high, yet gold is breaking all-time highs. This is the Reuters paradox. The smart money isn't looking at the nominal interest rate, the number the bank gives you. They're looking at the real yield. If the bank pays you 5%, but the real-world inflation for the things you actually need, energy, food, housing, is 7%, then your real yield is negative 2%. You aren't earning money, you are paying 2% a year for the privilege of letting the bank hold your cash. The giants have realized that in a world of structural inflation, gold's zero yield is actually superior to a negative real yield on cash. They aren't chasing a 5% gain, they are fleeing a 100% loss of purchasing power. So, how do you swim with the sharks without being devoured? First, you must understand the difference between assets and claims. Most retail investors are currently buying paper gold, ETFs, bank certificates, or digital tokens. They think they own gold, but what they actually own is a promise to pay gold. In a systemic crisis or a bank holiday, those paper claims can be settled in cash or frozen indefinitely. The smart money, as we saw with the central banks, settles for nothing less than physical bullion. If you want to survive this shift, you need to think like a central bank. Own the physical. Hold the asset that doesn't rely on a working internet connection or a bank's permission to exist. Second, you need to ignore the news cycle and watch the macro cycle. Stop trading the monthly jobs report. The giants don't care about a 0.1% change in unemployment. They care about the fact that global debt is unpayable. They care about the shift from west to east. Your strategy shouldn't be to get rich quick on a gold spike. It should be to stay wealthy while the currency dissolves. Finally, look for the silver spring. As we researched, while gold is the king of wealth preservation, silver is the spring that is being coiled tight. With its massive industrial demand in the AI and green tech sectors, silver is currently undervalued compared to gold. If you can't afford a seat at the gold table, silver is the retailer's lifeboat that the smart money is also starting to stack. You don't need billions to play this game. You just need to stop playing the game the media has designed for you. You have to stop being liquidity for the giants and start being a giant yourself, even if it's on a micro scale. The exit door is still open, but the crowd is starting to notice the smoke. The question is, will you wait for the alarm to scream, or will you follow the footprints of those who have already moved their wealth to safety? The system isn't broken. It's working exactly as intended to redistribute wealth. The only choice you have left is which side of that redistribution you want to be on. We've seen the footprints. We've unmasked the real yield trap and the media-driven smokescreens. What remains is a cold, hard truth. In an era of infinite debt and geopolitical shifting, gold is no longer just a speculative trade. It has returned to its throne as the ultimate insurance policy for personal financial freedom. It is the only asset that stands independent of the mistakes made by central bankers and the decay of fiat currency. The global giants, the smart money, have already chosen their side. They are trading their paper promises for physical certainty. They are preparing for a hard world while the public remains distracted by the noise. So, I leave you with one final question. As the gap between the paper world and reality continues to widen, what are you holding? Will you trust the ink on a government-printed note or the enduring value of an asset that has survived every empire for 5,000 years? The central banks have made their move. Now it's your turn. If you've seen the signal through the noise, let me know in the comments by typing, "I choose gold." Don't forget to like and subscribe to stay ahead of the shift. Thank you for watching, and stay grounded.